This is Financial Standard, the definitive source of news, thought leadership and analysis for Australian wealth management professionals. Financial Standard. Take the lead.
Welcome to the Financial Standard podcast. I'm Financial Standard journalist Andy McKean, here today speaking with Hamilton Lane Co-Chief Executive Erik Hirsch to discuss the movement of private capital away from public markets. Welcome, Erik.
I am thrilled to be here. I really appreciate the invitation.
Thank you. So look, straight from the top, so what are kind of the most critical factors driving the shift of capital from public to private markets, and how do you foresee that trend evolving over the next few years?
Well, I think there's a few factors here. So if you think about what's happening in the public markets, there's really two things. One, we're not seeing the public markets grow in terms of count of companies. So today around the world, there's about 4,000 or so companies public in the United States, which is obviously the biggest public market. And that's really been in decline over the last few decades. So fewer companies becoming public. And that's not only true in the US, that's true in other major markets. And the second thing is we've never really seen concentration like we're seeing today, where just a small handful of companies are really driving an enormous amount of the return. So we talk a lot about those sort of technology-oriented businesses, and that's mostly what they are. And they just represent such a huge portion of the overall market cap. But I think for most investors in the public markets, they find themselves, again, through particularly a passive-oriented strategy, through just sort of a concentrated, very, very mega cap, very technology-oriented portfolio. And if we think about what the overall economy looks like, that's not what it looks like. So those are the two pieces that I think are underpinning this. And now you overlay the fact that data is becoming more readily available and that the individual investor is seeing what the institutional investor has been experiencing for the last several decades, which is that the private markets have been a big driver of their overall portfolio performance, and they want in on that.
So I guess specifically then, how quickly do you sort of anticipate, the shift from public to private to really get to quite an enormous scale? And what do you see as kind of maybe perhaps some of the key benefits and also the key risks likewise as well?
So I think this is a marathon, not a sprint. I think you're talking about an awful lot of capital that is going to be moving over long periods of time. If we think about this from what the typical individual investor has today, the typical individual investor today has zero exposure to the private markets. So ultra high net worth people have some. But if we're talking about, again, sort of the average consumer, they don't have it. They don't have it in their kind of set up retirement funds for the most part. They don't do it individually. And so that's where we're starting from. We're starting from a base, for many, of zero. And so if you think about the institutional investor, their average allocation today to the private markets is running between 10 and 20%. So the move, if we think that those two are going to start to mirror each other over time, the move from basically zero somewhere to 10 or 20% or even higher is going to take an awfully long time.
But do you think kind of efforts to democratize are underway, aside from high net worth individuals?
I absolutely do. And so that comes down to structure. So if we think about what has typically been the fashion that individual investors can access the private markets, it's been through the exact same structure that institutional investors have, which is closed-end funds that are drawdown funds. And those funds tend to be 12 to 14 years in length. And again, capital getting drawn down over long periods of time. That's not a great structure for most individual investors. A lot of mechanics, a lot of moving of capital, a lot of things to keep track of. And so not a particularly appealing structure. Now what we've seen is really in the last 5 years, kind of the emergence of what are referred to as evergreen funds. These are perpetually invested. And so when you come in as a new investor, you're fully invested on day one. No capital calls, no drawdown notices, and these vehicles offer liquidity provisions. So we've taken two of the things that sort of heretofore have been very difficult for individual investors to deal with. Capital call drawdowns and no liquidity. And those have kind of gone away through some innovative and new structures. And I think that, coupled with the fact that there's now lots of flavors of these being offered, is really solving a couple of the key issues that have otherwise kind of plagued the individual investor.
In terms of back to the kind of the snowball of capital towards private markets. So, look, in response to kind of that growing preference for private markets, some of our regulators have said that, that could potentially lead to a reduction in the available of capital for public markets. And they've put forward certain measures to try and make listing publicly more attractive. Do you think that, should companies have things like a more gradual phase in of reporting obligations or perhaps a honeymoon period for that? Do you think that in that environment, could those potential sort of measures impact the flow of capital towards private markets, perhaps if they have some of the red tape they have to adhere to wound back?
I think both things would be positive. I don't think we never view this as a competition between, in order for the privates to win, the publics have to lose or vice versa. I think both absolutely play a vital part in investors' portfolios, and investors should have access to both. So I think we can sort of see a world here where both things can be true. I absolutely believe in Australia and in other sort of significant markets that we do need to make becoming and being a public company a little easier. That's not to say less regulated or less oversight. I think that's to say less bureaucratic, less expensive. There's an awful lot of rules and regulations that I think at the end of the day don't necessarily protect investors any better, but make running a public company very difficult. I know because Hamilton Lane is a public company. We've been traded on the NASDAQ now for a number of years. And so while we enjoy a lot of benefits of being public, I live it every day there are just some real complexities to being a public company. So I think we should see a world where a little easier to be and to remain public, and that would give investors a broader access to a wider number of companies in the public markets, and at the same time, recognizing that most of the economy is really driven by privately owned businesses. And if we think about just from a sheer count perspective, there's many, 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 many multiples of private businesses than there are public businesses. And so if you want just to get exposure to kind of what's happening in the economy more broadly, you're going to want to make sure you're getting exposed to both.
Certainly. One other thing that's kind of come up, it's in discourse here, is that there are concerns about conflicts of interest and potential asset valuations in markets, with calls for perhaps greater transparency and stricter regulations. Do you agree that the industry needs to kind of address these issues to enhance investor confidence and increase market integrity?
I think the market has already addressed these issues. I hear the concern, but I think as someone who's running funds, we see them as highly regulated. There's total asset transparency, and in our situation, monthly mark to markets done by both internal and external resources. So I think valuations are something that regulators should always be focused on, and I think that's a good thing. And again, anything that sort of increases investor confidence, I think, is also positive. But I would say the market is quite mature in dealing with these issues already, and I don't see this as sort of the issue that is sort of the Achilles heel, the potential Achilles heel for the industry.
If I can change tack for a little bit here as well. So could you explain your belief in tokenization having the capacity to kind of transform how investors access private markets as well?
So I think about tokens as really just an easier access point. So from an analogy standpoint, you're a young guy, much younger than me, but if we sort of think back to when we would check out of a grocery store, if we went back sort of 30 years, a lot of people would pull out a checkbook and they would pay for their groceries by writing a check. And we then began to see credit cards become much more sort of omnipresent, and people were putting away their checkbook and they were pulling out their credit card. And in the last few years, we've sort of replaced the credit card with Apple Pay or something of the like, which is even a faster, sort of easier way to transact. I think about tokens as really sort of the Apple Pay of the private markets. So today, the private markets actually are quite arcane when it comes to sort of subscription documentation and transactions. So I think of us as really a bad version of a checkbook, and tokens taking us much closer to an Apple Pay environment. So this is about just the method for transacting. I think tokens sometimes get misunderstood as trying to disintermediate. I don't see them as a disintermediation. I see them simply as a transaction methodology. So quite simply, if you as an investor went to a variety of token exchanges that exist today in Asia, throughout Europe, throughout the United States, in Australia, you would sort of open up an account. You would go through kind of that know your customer money laundering regulation one time, as you do now when you open up a bank account, and you would have a digital wallet. And with that digital wallet, you could fund that digital wallet with whatever mechanism is convenient for you as the consumer. And then you could essentially go shopping on the exchange for funds that are available by token. Now, you could do the shopping, or if you had a financial advisor, perhaps you have a professional money manager who's helping you, they could do the shopping and they could still do it sort of via tokens. So I don't see tokens really as sort of I don't think they're more geared necessarily to the kind of quote, do it yourselfer investor. I see it as simply a way to kind of point and click and acquire something much faster and easier than it would be to kind of do it the traditional method. The other benefit of tokens is it creates another mechanism for liquidity. On these exchanges, tokens can be traded, and tokens can also be broken into smaller pieces. So right now in the private markets, in order to kind of get liquidity, it tends to be an all or nothing mechanism. You either sell none of your stake or all of your stake. And in token world, you can do a much finer job of rebalancing your portfolio and asset allocation by saying, I'm going to sell 1/16 of my token. And I think that allows for just better, more responsible money management.
Do you think that kind of fractionalization that you can achieve through tokens as well, do you think that that kind of plays into the democratization of private markets as well?
I absolutely do, because it makes the investment minimum smaller. And so, again, if we go back to kind of traditional private markets, closed-end funds, very institutional oriented, most of the minimums to become an investor in one of these funds have typically been between 5 and 10 million USD. Well, that's not democratized access. That is rare air for a very, 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 very small portion of the population. And so in a world where through tokens and through other structures, we can have a world where $5 or $10 million becomes $5,000, that is a whole different level of access, and again, allows individual investors to enjoy something that institutional investors have been enjoying for a long time.
I guess then I would like to ask, kind of how far along we are in that journey in terms of transitioning towards, adopting tokenization and moving away, I guess, from traditional transactions, where we kind of currently at.
So I'll go back to my race analogy. We're about to go run a very, very long race, and the starting gun has just sounded. That's as far as we are. Exchanges exist. There are a handful of fund managers who have begun to tokenize. We've been one of the leaders of that. There are several Hamilton Lane funds available on various exchanges around the world, but it is very early days. So I would say we're kind of in the education phase and the creating awareness phase, but we're not past that. So this is going to be a journey, and people need to begin to understand what tokens are and what they're not. I think, unfortunately, one of the things that's been a real hindrance for tokens is that they are often confused with crypto. And so sometimes we sort of think of them as one and the same. The only thing they share in common is a blockchain backbone. Tokenization is not a play on crypto. It is not a play on coin value in any way, shape, or form. They simply share the same infrastructure backbone of using blockchain for that.
Any other immediate sort of hurdles that come to mind when we're talking about tokenization as well? Obviously, if we're still in the education component and there's misconceptions about what it is there anything else that you can kind of envisage along the way?
I think education always takes a long time. I think when you're talking about introducing to people, you think about how credit card adoption, for credit cards to go from kind of 0% adoption to sort of 90% adoption took several decades. And so we sort of think now of like, oh, everyone kind of very quickly had a credit card. They didn't. It took literally decades for that adoption to go from zero in sort of the late 50s, early 60s when the first credit card was introduced to sort of the 2000s when you actually had reached kind of a high 80s to low 90% adoption rate. That was decades of education, people gaining comfort. No different than when we think about buying things on the intranet. That took a long time when we sort of went from just being willing to sort of buy a book and thinking that that was a risky transaction to being willing today to literally buy anything on the internet. So I think this is another one of those analogies. This is a really significant change in how people think about transacting and storing assets. And so gaining comfort, people needing to feel secure, people needing to feel like they understand and they have choices. I think this will take some time, but the benefits are so significant that it's rare that you see something that's better for the investor and for the fund manager. Usually one benefits and one doesn't. Here, it's benefits for both. And so a world where it is sort of better, faster, cheaper for both parties, I think that sort of says you're going to see adoption, because when it's good for all, things tend to get adopted.
If I can just squeeze in one more question, and that's just given the current macroeconomic environment, potential for interest rate drop quite soon, and some potential economic uncertainty as well. I just wanted to know what your outlook was as well for private markets over the next few years, and perhaps how you think some of these factors might conflate to influence investor behavior.
If we look back over the last 2 decades, the outperformance of the private markets has been very significant relative to the public markets. And over those 2 decades, we've seen all kinds of different economic cycles. And regardless of what cycle we were in, the outperformance has been quite persistent. So why is that? Private markets have really simply been about buying good businesses and making them better. Private markets really fuel the vast majority of their return, not through leverage, not through multiple expansion, but actually through earnings growth. And so that's a fundamental alignment of owner, management team, shareholders of, we own this business together. Let's try to make it the best business we possibly can. So I think despite what we're going to see with some rate changes and there's a whole lot of geopolitical uncertainty, I think fundamentally the private markets are sort of geared towards find good businesses, let's properly incentivize management, let them work, and let's grow that business. And so my outlook for the private markets is bullish in the sense that things will not be perfect and things will not be easy, but that fundamental business model of getting those businesses and making them better businesses, I think works regardless of where we are in the economic cycle.
Fantastic. Thank you so much for your time, Erik.
It's been a real pleasure. Thank you.
Thanks for listening to this Financial Standard podcast. For more information, visit financialstandard.com.au. Please keep in mind that the information discussed in this podcast is general in nature and does not consider personal circumstances. Reliance should not be placed on any content without further independent financial research and advice.